Index funds versus ETFs. Differences you must know. Hi everyone and welcome back. In today's video, we are going to discuss the key differences between index funds and exchange traded funds or ETFs. Both of these investment options are popular, but they function in slightly different ways. If you're considering investing in either, understanding these differences is crucial. Let's get started. What are index funds? Index funds are mutual funds designed to track the performance of a specific market index, such as the Nifty 50 or the BSE 500. They are passively managed, meaning the fund manager doesn't pick individual stocks. Instead, the fund aims to mirror the index's composition. For example, an index fund tracking the Nifty 50 would invest in the same 50 companies that are part of the Nifty index. The goal of an index fund is to match, not beat, the market's performance. What are ETFs? On the other hand, exchange-traded funds or ETFs are similar to index funds as they also track market indices. However, unlike index funds, ETFs are traded on stock exchanges just like individual stocks. This means you can buy or sell ETFs throughout the trading day at market prices, unlike index funds, which are only bought or sold at the end of the trading day. ETFs are also typically passively managed, tracking specific indices or sectors, but the key difference lies in how and when they can be traded. Key differences between index funds and ETFs. Trading flexibility. As mentioned, one of the biggest differences is how they are traded. Index funds are bought and sold at the end of the trading day at the NAV, that is, net asset value, while ETFs are traded like stocks, meaning their price can fluctuate throughout the day based on the market conditions. Expense ratios. Both index funds and ETFs tend to have lower expense ratios compared to actively managed funds. However, ETFs might have slightly lower fees, but remember, ETFs may incur a small trading commission or brokerage fee when buying or selling depending on the platform. Investment minimums. Index funds often have minimum investment requirements, which can vary from fund to fund. ETFs, however, can be bought in small quantities, usually one unit at a time, making them more accessible for investors with smaller amounts to invest. Income distribution cum capital withdrawal, IDCW reinvestment. Index funds typically allow automatic IDCW reinvestment. ETFs, on the other hand, may require you to manually reinvest IDCW depending on your broker. In conclusion, both index funds and ETFs are ways to gain diversified exposure to markets at low costs. The key differences come down to trading flexibility, expense ratios, and the ease of investing. It's important to consider your investment goals and trading preferences before deciding which option is suitable for you. If you found this video helpful, don't forget to like, comment and subscribe for more financial insights. Thanks for watching. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.